Good morning, everyone, and welcome to our DeFi webinar. I'm sure we're all interested in hearing about this topic. So without further ado, I'm going to turn it over to Tarun Chitra and Alex Evans, and they're going to kick it off. Let's go.
Hey, everyone, can you hear me okay? Great. So I'm going to share my screen here and let me know when you can see it. Can you see my screen?
Yep.
Yeah, great. So thanks for hosting and thanks for everyone for joining us this morning. So today we're going to talk about, as the topic suggests, decentralized finance. This is a topic that at least the three of us, Guillermo, myself, and Tarun, have found very interested in spending a lot of time over the last couple of years working on. We hope to share some of that excitement with you today. What I'll do in this presentation, or at least my portion of this presentation with Tarun, is provide just the basic 101 of what DeFi is in layman's terms. So no formal definitions, no math, just casually explaining what DeFi is, what's exciting about it, what some examples of DeFi services are. The thesis I hope you come away with is just that there is a parallel-like financial system emerging on public blockchains that is still really small, but is growing very quickly. It provides a lot of interesting opportunities for practitioners, as well as very interesting research questions for academics and researchers in the space to tackle. So the structure of this presentation is going to go as follows. So I'll provide a little bit of background on myself and Tarun. Some background on smart contracts I think will be instructive. I suspect a lot of the people in the audience will be at least minimally familiar with these, or at least will have a background understanding of Bitcoin. So this might just be some useful analogies just to level set with everyone, starting, keeping with the spirit of doing a 101 presentation. Then in that context, I'm going to ask the question of what is DeFi? What's a working way of understanding what DeFi is? I'll talk about some of the properties that DeFi systems have that make them interesting, at least to us. And then I'll give some concrete examples of DeFi services. So what I like to do, at least what's helpful for me to understand kind of more abstract things, is to look at concrete examples. So hopefully this is useful to you as well. I'll just give examples of the most popular DeFi services and leave more exhaustive descriptions to, actually Tarun's going to go over some examples of more exotic like constructions in DeFi. I'll talk a little bit about the state and growth of DeFi up till now. DeFi is a sector that's been inflecting over the last couple of months, and seeing that context I think will be helpful. Tarun is going to then go into some of the open challenges that DeFi faces, some of the opportunities ahead of us, and some of the future innovations that he's anticipating in the space. So one way of thinking about the sequence of presentations here is I'm going to do 101, Tarun's going to go maybe 102, and then Guillermo's going to be much more careful about definitions and so forth, and give us a specific description of constant function market makers, which are an incredibly important primitive in DeFi, and give us an interesting description of the various properties and ways in which they work. So a little bit on us. I am an investor at Placeholder. Placeholder is a venture capital firm. We invest in decentralized networks, and that includes a number of different DeFi protocols and applications. In addition to the investing role that I have, I end up doing a lot of research for Placeholder, either in collaboration with our portfolio companies, but sometimes in just tangentially related areas to our main investment practice. So in the past, those have included things like credit risk in MakerDAO, which is a lending protocol that we're going to describe a little bit later in the presentation. Some of the financial mathematics of what are called geometric mean market makers that are a subset of the constant function market makers that Guillermo is going to talk about. I've also done some work with Tarun on staking derivatives, which are ways in which validators and proof of stake networks gain liquidity on their staked assets, as well as some additional work with both Guillermo and Tarun on curvature in constant function market makers and its implications for market microstructure, as well as a recent piece that we put out on optimal fee selection in geometric mean market makers.
Hey, and I'm Tarun. I previously kind of worked in a bunch of different industries, but I spent some time in algorithmic trading before this, so I kind of take a little bit more of the sort of microeconomic sort of agent level view of the world when analyzing these protocols. I founded a company called Gauntlet that stress tests sort of and does sort of actuarial simulations of kind of some of the systematic risk that's sort of on the kind of multi-protocol level that occurs in DeFi, some of which is quite unique to the space versus traditional sort of insurance markets and traditional trading markets. I also sort of help do some investments at a kind of very small place called Robot Ventures, and we sort of spend a bunch of time on kind of helping fund some of these more esoteric economic mechanisms that people are developing. And sort of, I guess, research-wise, spent a lot of time writing some of the first peer-reviewed papers on Uniswap and Compound, which is a lending protocol, and CFMMs. And then also had written some work on, like proof of stake and proof of stake derivatives, kind of figuring out sort of what the financial safety of those networks are.
Okay, so just to start off with basic description of smart contracts. Again, nothing in here is going to be formal in any way. Everything's going to be very much in layman's terms. So if the lack of specificity frustrates some of the more academically inclined members of the audience there, I will note that there are more precise descriptions of these things available. But just one analogy that is often used, it can appear somewhat silly, maybe a lot of people in the audience have already heard it, is that the first example of a smart contract is a vending machine. It's not quite perfect as an analogy, but you'll see why I use it in a minute, in the sense that you have a vending machine, it's displayed in a public location, somebody can walk up to it. If they want a soda, they know exactly what sequence of operations to execute in order to obtain the thing that they want. So you put a coin, you press a button, and then you get out the soda that you want, right? So smart contracts are similar in the respect that they automatically execute a set of instructions, but unlike the vending machine that executes everything locally, the execution actually happens over a network of distributed nodes all around the world. And what that gives smart contracts that, for instance, vending machines don't have is this property of censorship resistance, and that the execution of a program cannot be halted by any one particular node, and that you actually have to compromise a large network of nodes in order to prevent the execution of a program from happening. So at the point at which a smart contract-based program has been deployed, it is very often the case that even the creator of that program cannot stop somebody from executing a sequence of instructions. If it provides the right input, it will give the same output, whether or not the person that created it is happy about that use or wants it to continue. So the immutability property that censorship resistance gives to these smart contracts makes them unique, at least as far as I know, in computation, and allows certain interesting properties of things like DeFi to emerge. So in that context, I'm going to ask, what is DeFi? And the simplest, maybe silliest definition of DeFi that I like to use is that they are financial services, so things like lending, trading, insurance, derivatives, those types of things that are deployed and provisioned through smart contracts. So because they are deployed and built in this way, they end up inheriting a number of different properties of smart contract-based platforms. One of them that we find very interesting is open access, in that anybody can, with an internet connection, a small amount of capital, can access the service that the smart contract provides. Whether they're banked or unbanked in the developed world or the developing world, they can access, for instance, a lending service or a trading service if they are able to establish a connection to the blockchain and send a transaction. Another interesting property that may be more interesting to people like myself and Tarun that end up investing a lot in the space is neutral infrastructure, in that in the traditional web, very often entrepreneurs find themselves building on platforms that could change their terms of service, either for legal reasons or because they have changed their business model, or because they're interested in copying something that's been built on top of them. And so it can be very difficult for somebody to build confidence in developing something that uses the functionality of an underlying system that might change rapidly underneath them. The immutability of smart contracts makes that significantly more difficult, at least in principle. And so developers like the idea that they can have confidence in the infrastructure that they are building on being neutral to their application and their particular use case. The other property that I think could be probably an entire separate conversation and topic to discuss in its own right, but I'll go through very, very quickly, is composability. Composability, the simplest way to understand it is that developers can pull together components from different underlying systems and protocols and stitch them together into tailored end user experiences. So without needing permission from anyone who built the other contracts, you could pull together a lending contract, a trading contract, an insurance contract, and build a hybrid of those three that is greater than the sum of its parts. All the APIs to do so are completely open and permissionless to use in that way. Another property that is interesting and can be very interesting to people trying to study these systems or use them as examples of testing beds for different types of ideas in economics and finance is that all the data and the code is transparent. So very often, or in the vast majority of cases of these DeFi contracts, the code is completely open source. Everybody can see exactly how contracts execute certain operations. And in addition to that, the entire state and history of the state of those contracts is available to anybody who takes the time to scrape it and audit it. So anybody can, it's a financial system that's almost built inside of a glass house that everybody can see the full state of the system. That obviously brings up a whole bunch of interesting challenges about privacy and so forth that are interesting in their own right, but also provides a lot of very interesting opportunities in auditing the history of these contracts up till today. And the final thing that I'll mention here as a property is shared state and deterministic execution. And part of the way of thinking about this property in a simple way is asking the question of what if all financial services, and this is very informal, share the same backend, right? In other words, what if a bank account and a trading account were able to sync automatically on like who owns what without anybody needing to take credit risk in between when you send your money, let's say from Wells Fargo to Robinhood. That allows us to do certain things that require the property of what's called atomicity. And Tarun's going to talk a little bit later about flash loans. There are a DeFi native type of application that, frankly, at least I don't believe has direct analogs in the traditional financial system. This depends directly on this property of everybody kind of sharing the same backend service in Ethereum in most of these cases, or another smart contract platform that these services happen to be built upon. So here, just first of all, for disclosure purposes, I've highlighted different investments that could be broadly related to DeFi that placeholders an investor in. But another point of this slide is to give an idea of the breadth of different financial services that are available to users of these systems. So this includes things like lending, it includes things like decentralized exchange, a whole bunch of different flavors of decentralized exchange, portfolio management, risk management, insurance, and a whole bunch of other things. This is not even an exhaustive list. There's probably dozens that pop up every single day at this point, especially since DeFi is undergoing this period of significant excitement in the community. So I'll get into some specific examples now. And the first one I want to talk about is lending protocols. These are probably the oldest applications of DeFi, at least that I'm familiar with. And when I say the oldest, by the way, I mean that they're a couple years old, maybe 2 or 3 years old. They are also incredibly popular in that they now hold billions of dollars worth of liquidity, at least the ones here in the middle that I've highlighted, Aave and Compound certainly do. They facilitate billions of dollars worth of trading volume as well, and have undergone significant amounts of growth in the last couple months, especially. So the way that these work, and again, I want to return to the analogy of the vending machine, is that you have lenders and borrowers on one side and the other, respectively. The lenders want to lend some amount of capital, so they come in with, let's say, $10 worth of coins. They deposit them into this smart contract / vending machine. You put in some amount of coin, you get back a lending voucher. Now, the lending voucher can be redeemed for the principal plus whatever interest has been accrued in between when the original deposit happened and when the withdrawal happened. That is obviously barring the fact that there's some amount of credit risk, and you might actually only be able to partially recover some of that. But we'll leave some of that complexity to the side just to describe the basic mechanics here. So lenders deposit, they get back this lending voucher. So this person, let's say, deposits 10, this person deposits 20, this person deposits 20. So now we've capitalized what's called a lending pool inside of the smart contract with $50 worth of reserves, right? So now comes a borrower, and the borrower wants to borrow $1 worth of liquidity. And here there's 2 things to note about this borrowing. One is the fact that they're putting out more collateral than they're actually borrowing. This is the case, at least in Aave and Compound. There are a couple proposals that try to limit the amount of collateral that's required. Actually, some achieve radical reductions in the amount of collateral that they require borrowers, but at least the most popular lending protocols do depend on over-collateralization. Part of this has to do with the property that I discussed earlier of open access, and that these are typically pseudonymous people on the internet for which you have no recourse if they don't return their loan. So you require over-collateralization. The types of use cases for which over-collateralization is required are more limited than more general lending, at least in the traditional world. Typically, the way it works is that somebody has, for instance, $1.50 worth of some currency that they want to go long, like Ethereum. They're excited about Ethereum and think it's going to go up in price. So they put up $1.50 worth of Ethereum, and then they borrow $1 and then use that dollar to purchase more Ethereum. So now they have $2.50 where they previously would have had 1.5. Obviously, that magnifies their upside, but also increases the potential for losses. So it's very much a traditional leverage system in that way. Here with 1.5 times collateral, you can take up to 3 times your initial position. So a significant amount of leverage for somebody that otherwise doesn't, potentially have a credit history and so forth, which brings up on a whole bunch of interesting challenges around risk and so forth, and how to set these collateralization ratios and interest rates. So turning to the interest rate now, the interest rate typically that these smart contracts charge is a function of how much of the overall reserve is being utilized. So the idea being, as you utilize more of the reserves, more of your reserves are being lent out, you're actually taking more risk in that, some adverse event could cause you to lose more of the principal of the lenders that the lenders have provided up to that point. So here we're taking out $1. That represents just 2% of the overall pool of, as we said here, 50. So, the interest rate potentially that we charge here is very small. So that's to say 0.1%. The next person takes 20. So that's a bigger share of the pools. Maybe we charge 4%. And then the next person takes 20. So we've lent out 41 to 50. That's very significant. Potentially we're concerned with the amount of exposure and risk that we're taking on through the series of transactions. So maybe now we're charging 15% interest to these folks that have taken out such a large part of the overall pool. So what have we achieved here? We've achieved the ability for lenders and borrowers, without knowing each other, without trusting each other, without having much knowledge about each other, to transact and borrow and lend from each other. At any individual time, the lenders can audit the exact amount of collateral that's in the system, as well as all the code of the lending contract, and make their own risk analysis as to whether they think it is prudent to continue to lend capital to this pool. Firms like Tarun's firm actually help with automating some of that process of risk assessment, and help protocols, for instance, set their interest rate and collateralization factors and so forth through expert analysis. So there's a number of different people now that are using traditional risk tools as well as more adapted tools to understanding the risk of these different systems. This is a really interesting challenge for the academics in the audience, in that this is a very different way of lending and involves a unique set of risks that as of yet are haven't been studied very significantly. Okay, so here's another example of a lending protocol. It's a little bit more idiosyncratic than the other one. In some ways, actually, I would say that it's more familiar to those that are traditionally used to more normal banking services in the traditional world, in that banking doesn't literally work, one borrower to one lender or one-to-one capital matching between borrowers and lenders, and that typically reserves are created at the point of origination of a loan. Another reason why I mentioned MakerDAO explicitly is because it is the largest DeFi protocol, at least as far as liquidity goes. And basically, if you look at this, it's a normal lending protocol in the sense of the previous slide. Here, the right-hand side is almost identical, at least the borrowing side. There is two key differences, I should say. One is this DAI, and DAI is a stable coin that is intended to track the price of $1. And we'll get into how the protocol does that in a second. And that is primarily through the stability fee up till today. The stability fee is the interest rate that the protocol charges. Now, unlike the previous example where the stability fee was set as a function of the overall reserves that had been lent out up to that point, the stability fee in this case is actually voted on by the holders of a separate cryptocurrency called MKR. So once a week or every so often, these cryptocurrency holders hold a vote, and they vote on what they think that week's stability fee should be. So they could have a higher stability fee indicating tighter monetary policy, a lower stability fee indicating a cheaper cost for borrowing for borrowers entering the system. They take into consideration a lot of different factors for determining the stability fee. One of those factors is where DAI is trading relative to $1. So if DAI is trading above $1, that means that there is not enough DAI potentially in circulation. So they decrease the stability fee to encourage more people to create more DAI and sell it on the market to bring down the price of DAI, and vice versa. If DAI is trading below the peg, typically they'll try to increase the stability fee to encourage more people to purchase DAI in order to pay back their loans. There are other factors, of course, including the risk profile that they're taking on and ensuring that the stability fee matches or is commensurate to the amount of risk that they're taking on. depending on the collateral, the types of borrowers that are entering the system, the types of market conditions that the protocol is subject to, and so forth. So these are votes that are taken on and debated by people in the community. You can find YouTube videos with all the proceedings and different arguments that people have had within the MKR community. Very often it is the case that these people are random individuals on the internet having discussions about, what that week's monetary policy should be. Should it be tight or should it be loose, and so forth. And sometimes that leads to some really interesting results. So the next protocol that I'll talk about here, and Guillermo is going to give us a much tighter definition of automated market makers. So automated market makers, or AMMs, or constant function market makers, more specifically here, involve, you can think of them somewhat as automated portfolio managers that also facilitate a trading function, in that the way that they work is that they involve an invariant of the different reserves. And there's a bunch of T's that I'm not crossing here and I's that I'm not dotting that Guillermo will then come back and dot and cross for us. But I want to give just an intuitive explanation of how these things work. This is the Uniswap-like invariant. So starting from the very beginning, you have somebody who wants to supply liquidity to an automated market maker. They supply $1, let's say the price of X and Y, coins X and Y are each $1. They supply 10 units of coin X and 10 units of coin Y. And that's $10 and $10. So they have a 50-50 pool here. Similar to the smart contract as a vending machine analogy, they send these two coins in, they get out this IOU. This IOU can later be redeemed to their pro rata share of the overall pool, which in this case is 100%, that otherwise would not be. Plus whatever trading fees have been accrued in between when they deposited and when they withdrew. Okay, so to understand this invariant, we're going to go through an example. The idea is simple, and that is that this liquidity provider has provided 10 units and 10 units. The intent of the contract is that any trade that trades between X and Y should maintain this invariant. In other words, 10 times 10 equals 100. So any change in these reserves should still result in a product that is 100. So concretely, what does that mean? Let's say another trader comes in and they want 1 unit of coin Y, in the same way that you walk up to the vending machine and you want to know what you need to do in order to get 1 Coca-Cola, right? So they say, I want 1 Y, and the contract says, okay, in order for you to give me that, I know that I will go from having 10 Y to 9 Y. And so I need to know how much of X I need to have in order for the constant product to be 100. So I actually need 11.1 periodical. So in order to do that, I have 10. So I need you to give me 1.1 periodical X plus typically a small fee in order for this trade to be permissible in the system. So let's say the trader goes ahead and executes this. Then a smart arbitrager notices that actually, if I send 1 Y, let's say the price of Y and X hasn't changed, it's still $1. If I send 1 Y to the contract plus a small fee, I will get back $1.1 worth of X. And if this fee is small enough, this will be an actual arbitrage that they will be able to profit from. And this will restore the reserves to 10 times 10 equals 100. There's a couple things to note here about what we've accomplished. First of all, we've accomplished the fact that the pool now is back to 50-50, and this is no accident. That in Uniswap it is the case that the pool will be, that arbitrageurs are incentivized to rebalance the pool back to 50-50. So the liquidity provider that originally supplied the liquidity is then able to say, I have something that resembles an ETF that's continuously being rebalanced through the process of arbitrage. The other thing to note that's interesting here is that the liquidity provider has gone through this round trip of a trade and an arbitrager. They've collected some fees in addition to this rebalancing function that they've had. Sometimes those fees may compensate for the arbitrage loss that they incurred. Sometimes they may not. That's also an interesting topic of conversation. And the final thing that's interesting here is that these pools, through this process of arbitrage, as the example trivially shows, is that the pool's implied price is now 1-to-1 of X to Y, which is the true price of X and Y. This is commonly referred to as the oracle property that these automated market makers tend to exhibit, because arbitrageurs have the incentive to bring the implied price of the AMM and that of an external market into alignment. And so typically smart contracts don't have access to the external state of the world, but they can read the state of an automated market maker in order to infer things like prices, relative prices of two different assets, which is another interesting property of automated market makers that are deployed on public blockchains. So another even more native application of DeFi is flash loans, and Tarun typically gives a better description of these than I do, so I'll turn it over to him to explain flash loans.
Thanks. Yeah. So one thing to think about is, in a traditional centralized venue, so like let's say NYSE or CME, the broker, primary broker, and exchange tends to provide you margin for doing trades. They're kind of the way they provide you margin is they have a bunch of systems where they provide you some margin. You do some trades. If you reach some liquidation threshold, you get liquidated and you lose your collateral or your maintenance margin or some type of notion of state that you keep on the exchange. In the decentralized world, that's actually a lot harder. So liquidations, kind of in the earlier examples that Alex talked about, liquidations are still necessary. So when you have an over-collateralized loan, such that the collateral at some future time is worth less than the lien that was taken out, you need liquidators to show up. Liquidators is anyone on the internet who goes to the smart contract and says, here is some money, let me enter this auction, kind of buy the foreclosed upon collateral, and then they basically take the under collateralized debt from the system. And so one kind of interesting thing about liquidations is you sort of need a notion of a loan to do a liquidation, because somehow you need liquidity to buy the foreclosed or defaulted asset. So let's say I had some Ethereum, I borrow $150 of Ethereum, I borrow $100 against it, and then the price of Ethereum crashes 33%. So now it's worth as much as I've borrowed. I'm liquidated. The liquidator has to buy my Ethereum. So they take dollars, then they buy the Ethereum, but somehow they need some notion of leverage in a lot of cases. They either need to borrow against assets they have to get the asset to borrow, or they sort of, the liquidators kind of themselves are doing a rebalance in order to be able to execute a liquidation. So why I bring this up is that in traditional finance, a centralized venue, in order to perform a liquidation, doesn't need to lend to itself. It literally seizes the collateral of the user and sells it on the other side of an order book. In DeFi, it's actually a lot more difficult to do such a thing. And when you have many parties who are kind of adversarial to each other, it actually executing such actions is quite difficult. And one thing that kind of has come out of the intersection of computational complexity theory and sort of finance out of this whole, like, how do we solve this problem of decentralized liquidations, is this concept of a flash loan. And so what a flash loan is it's a lending pool, just like the ones that Alex talked about earlier, except when you borrow from the lending pool, you provide a function, which is sort of the function that you're going to execute given that capital. That function could be go trade on this exchange, go make 2 trades, make a round trip trade, come back, try to net to 0, or do some other type of activity on chain. And the idea is that if your function halts, and so the halting condition is actually quite important if you want to analyze it formally from like a computational complexity standpoint. If it halts and B is profitable, e.g. the account balance of the function is operated on a certain account balance, it does some actions and it comes back. And if the account balance is greater than where it starts, the loan is executed. So it's as if a lender could look into the future, say, hey, what are you using the loan on? And will it actually always be profitable? And if so, I will actually execute it. And this relies on the notion that given the state of a system and a set of capital, you can operate a function on that. And if the function actually halts, A, so it stops, it evaluates, and B, when it halts, it's profitable, it returns a higher quantity, then the loan executes. And so that's sort of a really, it's almost like a zero duration loan, a zero duration margin loan. And you don't really have that kind of limit as time goes to zero of duration loans in practice in any other sense. And part of the reason this doesn't really exist in the centralized world, and like, why doesn't the CME offer this to broker dealers or market makers, is because the CME does the execution themselves. So they act effectively as their own, if they don't halt, they're broke, they're out of money, right? So there's kind of a sense in which the centralized entities have natural reasons to kind of do things like this. They lend to themselves at zero interest rate instantly. But in the decentralized world, people don't do that. And so there's kind of this amazing fact of blockchains where in a kind of fully synchronous system where all computation is guaranteed to halt, then you can actually execute these types of loans that have zero duration risk. And what that did is the existence of these zero duration loans that allowed for liquidations to be done more efficiently basically catalyzed the growth of the lending pools. So the lending pools earlier this year were in the hundreds of millions of dollars of assets. There's been asset appreciation, of course, but the overall growth rate of the market has been extremely fast, and part of it was enabled by flash loans to ensure that kind of these unsafe positions could be liquidated. But this is a very nuanced connection between sort of computational complexity theory and mathematical finance, and I think this is probably the biggest innovation that we've seen in this space so far. But yeah, hopefully that, Alex, I think that.
Yeah. We might have accumulated some question debt, so this might be a good time to stop before continuing.
I don't seem to see any. Oops, sorry, maybe.
Yeah, I'm sharing screen, so I can't really tell.
Yes, I don't think there are any questions. I think we're good.
Okay, so we'll just keep going.
Yeah.
So I will just briefly talk about some of the current state of DeFi. I just want to give a sense of the growth rate of DeFi over the last couple months to those that haven't seen it. It's still a small sector, but it's growing very, very fast. And so that's kind of what I want to highlight here. But I also want to highlight it's still incredibly small relative to the order of magnitude of traditional finance and derivatives markets and so forth. So the first metric that some people tend to focus on is just the market capitalization of the different DeFi assets. Typically, these are equity-like instruments that are used to govern the different DeFi protocols and the different parameters. We gave an example of MKR earlier that is used to vote on different stability fees or interest rates that borrowers are charged. These tokens have recently the broader, every financial market is undergoing a little bit of excitement right now, and this is definitely the case in DeFi. And so we see the market capitalization of DeFi tokens really exploding in the last couple months, starting in the summer, but accelerating more recently. But the context here is that the broader crypto market, when we plot both of them, is orders of magnitude larger than DeFi. So one way to think of DeFi is as a growing but niche industry, and it's a niche within a niche, if you can think of crypto as a niche. Another interesting metric that we look at sometimes is trading volume across decentralized exchanges. I gave an example earlier of an automated market maker. These types of exchanges are actually the most popular, and Uniswap here in the pink is probably the largest one, certainly the largest one in terms of volume, one of the largest ones in terms of liquidity. So even since this summer, which had already grown from a significantly smaller base, we've seen an explosion in volume being facilitated by these automated market makers. These automated market makers very often now are competing regularly in terms of liquidity, slippage, and volume with centralized exchanges that are limit order book based and have been around longer or significantly longer than these market makers. So a big driver of the increase in volume seems to be, in addition to the excitement around the industry and trading interests, these automated market makers that have come to market in the last few years. Another metric that you sometimes might see in the DeFi space is what people call total value locked. And this is less like total value locked because nobody's physically locking this value. Typically be redeemed quite easily. It's more like a demand deposit in that regard. But it represents the total amount of value that's being utilized by smart contracts in DeFi services at any given time. And so again, similar to the other charts, we see this pattern of slow growth and a recent uptick in the last year, clearly, and especially the last couple months. Similarly here, it's very difficult to measure the actual number of users because, again, as I mentioned earlier, these are typically pseudonymous accounts. And so people can create multiple accounts or have multiple users represented by one account. So this is a very crude estimate. What we're actually counting here is the number of unique wallets as a potentially crude proxy for the number of users. And again, it's a similar trend happening around the same periods. So in terms of volumes, in terms of liquidity, in terms of prices, and in terms of usage, DeFi seems to be a sector that is still really small, but kind of reaching a point of inflection in the last couple months. So I'll turn it over to Tarun, who's going to talk about some of the deeper parts of DeFi as far as the challenges that we face and some of the future innovations that we're anticipating.
Yeah, definitely. So I think basically, if I were to kind of look at the future, I prefer kind of defining kind of the future in terms of two roughly orthogonal, but not completely orthogonal components. The first is the purely technological side. And so this is kind of understanding things like how do we improve blockchain state efficiency? How do we not store as much data on the blockchain because that's expensive? You force all, it's sort of a socialized costs that you force all miners and validators and potentially like clients to hold. The second is privacy. So, in the current state of DeFi, I think it's amazing it's actually grown as much as it has in spite of the fact that there's absolutely no privacy. And there are tons of services that exist now that try to identify addresses based on behavior and say like, hey, these addresses are controlled by this fund or this entity. And there's a lot of entity resolution that's kind of gone on, kind of not so dissimilar to kind of sort of traditional like intelligence agency type identity resolution. And it's kind of interesting because it's actually spawned a very different type of trading. Like I think there's a lot of rational trading that goes on based on you taking advantage of sort of identities of participants. But I think in the long run, if you want to actually get to something whose scale is closer to the remainder of the financial system, you do need some notion of access control, privacy, and data transparency that isn't totally doesn't reveal all private state of all participants. And the second is sort of chain interoperability. I view this sort of personally as the equivalent of adding Intel going from single processor to multiprocessor, or kind of having specialized hardware devices in your computer. There's a natural sense in which the kind of final sort of limit architecture of all of these developments will be kind of have chains that are specialized to different tasks, different performance benchmarks, different financial incentives, etc. And we sort of need those to be able to talk to each other. And so these are kind of really big problems, right? Ethereum right now is a TI-83. You're doing a very small transaction rate per second. As these financial instruments get more complicated and have a lot more in terms of state that they need to maintain and their derivatives transactions, so they have sort of quite complex pricing structures. You just end up having to have more computational complexity, and so kind of these three things I think are really important. But I think one thing, the sort of top image I have on the right, is sort of the rate of growth in this metric I use citations, but it actually should be kind of number of gates per unit time, but I chose a kind of thing that doesn't require you to really know much cryptography. But there's kind of been this Cambrian explosion in zero-knowledge proof generation, and zero-knowledge proofs allow for blockchains to kind of only have to store proofs that, hey, I gave Alex $5 and I did it via Uniswap, without actually having to reveal anything about my private information or my addresses. And so I think that's kind of the final frontier of solving these technical problems that, if we can really get there, we can actually build much more private and scalable systems. The second thing is mechanistic. And so this is really the kind of view I imagine economists, the portion that economists really care about. And so the things that are kind of missing in DeFi right now is oracles are still a little bit both centralized, but also kind of the conveyance of financial information across multiple platforms is still quite a bit hairy right now. We still rely on a few particular vendors. And I think the ecosystem would benefit from a larger variety of data to be conveyed on chain from the real world. So oracles represent data that's not on chain being provided to the chain so that the smart contract state can update. So for instance, Coinbase has an Ethereum USD price that gets conveyed to the chain that gets used to mark a derivative. The derivative might be now liquidatable based on that price. Well, who provides that price? How do we know it's not manipulable? Those are the types of things where there's actually quite a bit of complicated algorithmic game theory. The second thing I think that we saw and that drove the good dramatic growth that Alex just spoke about was liquidity incentivization. And so what that is sort of I would say, market maker, maker taker rebates 2.0. And what I mean by that is you effectively subsidize capital providers for locking up their capital to cover their opportunity cost of capital over a certain amount of time. And that has very big dynamic changes, because if one protocol suddenly over incentivizes, then all the capital from another protocol flees and goes to this protocol, but it might actually cause some systemic risk. And so figuring out exactly how to incentivize liquidity without overpaying for it is actually quite an important task for this space in the future. The next two are kind of related. So options for hedging instruments that are capital efficient, as well as insurance, and then exotic risk products. So you can actually view, for instance, a Uniswap share or a lending pool wrapper as an exotic risk product, but they have some kind of bounds on the kind of implied risk relative to their underlying collateral. But I think people really do want these synthetic assets. And I think we've seen a huge growth, especially since the Robinhood sort of debacle with T+2 settlement and DTCC, where people have been trading synthetic US equities on chain in a crazy volume. So synthetic US equities volumes went from less than $20 million a day in DeFi to roughly $200 to $300 million a day. So they've had this 10x growth over the last month. And these are exotic risk products because they're effectively contracts for differences that involve oracles and conveyance. And I don't think there's a particularly clean solution for correctly doing them. And the final thing is, as Alex pointed out, anyone on the internet can use these systems. But that also means there's no notion of identity. And so because there's no identity, you effectively have no recourse. And so these smart contracts effectively make recourse capital. So you have to over collateralize, you have to kind of do a lot more in terms of how you force users to lock up their capital. And I think that over time, there are starting to be much better mechanisms for reducing the amount of capital needed. And there's over time also becoming sort of like versions of identity that exist. And these versions of identity are more based on your on-chain activities. Next slide. Cool. So basically, coming from kind of the traditional world, you might say, okay, well, what's the point of this? If it's just reinventing the wheel, who cares? Well, I think there's a couple things to think about. There's sort of two ways of looking at this. So first of all, let's kind of look at the pros and cons. And so the pros are the design space is much richer than what you have in traditional finance. And part of the reason for this is that you combine certain elements of high frequency trading with certain elements of algorithmic game theory. So for instance, when you send a blockchain transaction, you have to bid on the transaction, and your bid indirectly determines your priority, or how fast your transaction will get executed. And right now we have a lot of competition for people who are doing arbitrage trades to incentivize their bids, to incentivize their transactions to get executed earlier. Now, curiously, what kind of this looks like is we have an auction. It's iterated on every block, but this auction is replicating a lot of kind of like what you have in high frequency trading, except you have to pay per message, which gets rid of a lot of the kind of spam problems that have kind of plagued centralized venues. And this changes the design space of like how you're supposed to think about building trading venues and building lending venues, because you actually have this sort of spam resistance mechanism, and you also force users to place capital on every trade. The second thing is that fully autonomous mechanisms for adjusting things like interest rates and adjusting things like collateral requirements are actually much more possible in this environment than the traditional world. In the traditional world, we still have a lot of crutches like LIBOR that are extremely manual and much more prone to manipulation, and there's no real transparency into actually how they're used. But if you actually ally to those factors from an economy, you can actually start thinking in terms of more like control theory mechanisms and things that have more of a flavor of sort of autonomous nature, where the financial instrument itself is changing over time, without needing lawyers, without needing kind of like a lot of the cruft of the 19th century financial system, and that still sort of exists in the legacy world. The negatives, well, lack of identity, of course, forces these kind of Lombard loan world, and so capital efficiency is, of course, a huge impediment to user adoption. Who wants over collateralized loans? Well, people with a lot of collateral. Kind of, I think the last thing to think about, and I guess Tim is in this call, but openness and public revelation mechanisms really kind of change how you prove theorems in this space. And so I think a really good example of this is Tim Refgarden's kind of analysis of EIP 1559, which is a change to Ethereum that changes how transaction fees are computed. And I think, an interesting thing that he points out is that you can't really apply traditional mechanism design kind of blindly to the space. You actually have to take into account that there are all these kind of idiosyncratic constraints, and you need to actually understand how the code implements them in order to actually think about the mechanism. And then last slide. So what's being built right now? We've kind of talked about the past, we've talked about the problems in the future, but like, what are people doing? Where has capital gone? There's, I would say at this point, probably hundreds of millions invested in DeFi since summer, probably billions. I don't know, Alex, you probably have a better estimate of that, but that money has to be going somewhere. And I think the main things it's going into are roughly categorized into algorithmic stablecoins. So people are trying to build more capital efficient stablecoins that don't require a one-to-one demand deposit at Coinbase or at Tether. Some of these are seigniorage models. So think of them as like central banks, but they autonomously adjust their emissions, kind of this control theory type of thing I was talking about. Some of them only promise you bounded variance over finite time windows. And those have been, I think one of them launched yesterday. So it'll be very interesting to see how well it does. I think it has $40 or $50 million of capital aligned to it. Hedging products. So I think crypto has proven that, unlike the normal financial world, people actually hate instruments with expiries. The most popular product in the space is what's known as a perpetual future, which is a collateralized contract for difference that has no duration. And instead of having duration, you have kind of this funding rate that gets traded between the longs and the shorts based on how the marked price changes relative to the overall demand on both sides of the book, which is extremely different from like going to the CME, where you have to deal with roll periods and things like that. So perpetual futures in crypto are really important. I think there's a lot of fundamental market microstructure reasons for why. Number one is the producers, like miners, they don't actually know when they want to sell in advance. Like they have some budget of like how much they want to sell at a given time, but they also have a variable amount that changes a lot with electricity costs. For instance, I'm sure miners in Texas, where I am right now, all shut off. There's absolutely no way any of them are mining with $1,200 BTU GCI costs. Like it's insane. So they have a sort of fixed versus variable cost structure that's quite different than I think a lot of other commodity producers that needs to be accounted for. And that changes the microstructure and is why people don't like these fixed expiry devices when you talk to kind of miners and people in that space. But the other thing is options. I think the options market's actually grown a lot in the centralized world, but the decentralized world has yet to find a good capital efficient way of doing it. I think these automated market makers, one of the reasons they're very popular is they're computationally cheap. And Guillermo's going to talk about this versus an order book. And so there's some way in which these two things represent an extreme and the set of mechanisms in between them. One of those mechanisms will be able to handle options much more efficiently. And that's kind of what people are looking at. Risk tranching, so people trying to basically say, hey, we'll buy some of your risk if you pay us some funding rate. And I think that's going to be important over time, just as people start kind of stratifying their and tranching their risk appetites. Systematic risk, so there's what my company does, which is really focusing on developing actuarial methods and sort of agent-based models of assessing kind of these tail liquidation events. And then there's people who try to socialize liquidation costs, like keep it down burnt. And the last thing is sort of what I'd call non-fungible finance. You should think of this as like asset-backed securitization. And people have kind of made these collector's items, which are like items on the blockchain. You can think of them as having a title, and the title sits on the blockchain and people can transfer the title to each other. And it's right now kind of mainly associated with digital art, but we kind of imagine that there's a world in which that more happens. And people have already kind of made the analog of asset-backed securities, so you can have fractional ownership of these titles and sort of IP type things. So by and large, that's kind of where things are going. I'd see that we got a few questions. So cool. So the first question, what scaling solution are you most hopeful about? I guess Alex and I might have differing answers on this. But I kind of am much more optimistic on Ethereum layer 2s. And in terms of other layer 1s, I'm much less optimistic. I tend to be of the mindset that stablecoin velocity, so dollar denominated demand instrument velocity, is the driver of usage in Ethereum. And you need to actually have that demand existing on these other chains, and that's quite hard. But I do think the long-term is ZK. There's absolutely no way it's anything else. It's just more a fact question of like, is this Intel in the 1980s or is this Intel in 2000? And from the perspective of zero knowledge proof generation, we're just not at the point that it's efficient yet. But there's a Moore's law going on. And I think hardware and algorithms and a lot of very beautiful algorithmic number theory will kind of improve us in that direction. Alex?
No, I agree with almost everything you just said. So we can keep going. But yeah, it is tricky, right, to figure out these cost curves with respect to zero knowledge proof generation, communication complexity, proof times, and so forth. Like anytime you have an exponential decay or like curve, it's very, very hard to figure out exactly where on that curve you really are and how far away it is. So in the long run, that seems to be where that's going. The question is, the trend line in the near term.
Cool. how much of DeFi currently depends on crypto prices going up? Your illustration of flash loans, how long will it survive a prolonged price correction? Yeah, so I mean, the interesting thing for MakerDAO, which is sort of the quintessential first DeFi protocol that Alex introduced, MakerDAO survived the like 90% drop in Ethereum price. And that's actually what made people have the confidence in using it. It grew to tens to hundreds of millions of dollars as Ethereum's price crashed, and arbitrageurs were able to kind of collectively liquidate collateral as needed. I agree that there's kind of now much more systematic risk over the whole space, with MakerDAO's initial kind of launch, they didn't have anyone else who was competing for capital in some sense, whereas now there's just many protocols. But I do think there's a bunch of papers, and some of them ours, and some of them like people like Aria at Cornell, who we've kind of proven that for some of these protocols, their safety does rely on the price process being a submartingale. So, there you go. If you want the like theoretical answer, I think number go up is quite important. But at least you have some slack in that I only said it had to be a submartingale. I didn't tell you it's, variance had to be bounded. So, Alex?
Let me stop sharing so I can see some of these questions. Unless somebody wanted to go to a specific slide, I can always go back to sharing. So where
how much does DeFi depend on prices going up?
Right. No, I think you covered that. So let's keep going because we have a good number here.
Yeah.
So in regards to automated liquidity and systemic risk, isn't DeFi specifically AMM, but also automated liquidation of margin loans currently highly vulnerable to a flash crash type event?
Yes, but the question is how big of a flash crash event, and quantifying that is important, and that's kind of active research area of what people kind of work on.
Right. And I think it's more so in margin loans than it is in automated market makers, which don't require these types of liquidation events. Now, a large price swing will result in a lot of arbitrage opportunities, and that is important to keep in mind as well. And that might stress chains, but otherwise, AMMs should be able to work unless prices go to zero. There's some like weird edge cases like that, but they can survive very significant drawdowns without really much turbulence, is my expectation.
One thing is the reason perpetual products and options are difficult is they combine liquidations with AMMs, and that is very hard. That's actually where the flash crash event is much more likely.
Who are the investors in these pools? I don't think we have that much great data on that. Anecdotally, I know some retail folks, and I know a good number of institutional folks that are now contributing capital to these pools, but I would love to see more data on that.
Yeah, I think there's quite a bit of data on chain. I would say there's certainly the top heavy funds. We kind of know who the Renaissance and Jump are of DeFi. It's kind of obvious, I guess, if you look at on-chain data a lot. But there are a bunch of exchanges. So exchanges have put a lot of funds in Compound and Aave to earn interest for users. So kind of in the same way that if you, I actually don't use brokerage accounts anymore, so I don't even know if they do this anymore. But I remember like 10 or 15 years ago when there was non-trivial interest, you could earn some interest for leaving deposits in your brokerage account. Like you would earn some savings rate, obviously zero negative now. But crypto exchanges offer that, and they do that by putting your funds into the protocols. So a significant portion of the lending pool funds comes from like big exchanges.
Let's we have a good number here, so I'm trying not to stress Guillermo. Who,
yeah. Maybe we'll give one line answer. So Xavier, I think most of the private tech in DeFi is unfortunately a little ICO boomy right now. a lot of people know the buzzwords and have been advertising things, but have very kind of nonsensical or like very unsafe designs and have no proofs and no guarantee. Like there's a lot of nonsense right now. So I'm very negative on them. And Guillermo's giving a talk on impossibility theorems, proving things you can't do soon. So yeah.
Maybe we should let him jump into it, and then we can get.
Let's get let's do it.
Hopefully everyone can see that. Is that cool? Okay, so I'm actually going to do the exact opposite. I'm going to be the annoying PhD student who actually goes really deep into one very, very specific topic. This time it actually happens that this topic is actually important for once, you know, as opposed to being, you know, the like one tiny point in a very general field. But it is one tiny point in a very general field that happens to be weirdly applicable. So kind of the point of this is supposed to be a contrast to the previous presentation, where it turns out, you know, we spoke very vaguely about a bunch of things that seemed like they might be interesting open research questions, but here things get weird. Actually, we have a bunch of weird theory answers to a bunch of questions anyone might ask that seem perfectly reasonable. And in particular, I'm going to focus on something similar to Alex's example of you know, this automated market maker. I take a little bit of issue with the framing of an automated market maker because it conjures up these visions, you know, of the classical automated market making literature about, you know, what people call prediction markets and all of these things. But it turns out they're actually very different beasts, and not very, I would say, shockingly different beasts, in the sense that they are essentially incomparable as far as we know under most reasonable models of market dynamics. Of course, you can't prove that things are incomparable. That's obviously a difficult thing. But anyways, so this specific class of automated market makers, which we use again as a very general phrase, right? So automated market makers, TM, I think might be the better statement of that, is what we're going to call constant function market makers. The naming will be clear in a second. But the idea is this is a very, very powerful primitive that has a bunch of connections to everything from kind of the classical market microstructure literature of Gloss and Milstrom all the way to weird portfolio rebalancing ideas. So if you want to target portfolio, it turns out you can kind of replicate such things by creating a special type of market and providing liquidity to it. So I guess let's see. So quickly, we'll go through some history of this. Again, this is to conjure up that part of your brain which might light up whenever you hear something about AMMs, and then we'll kind of go ahead and say, actually, it turns out this history is weird because it's an inspiration, but it's completely separate. Then we'll go through some, you know, like Alex said, dotting the I's and crossing the T's of what constant function market makers are, and then we'll kind of give a few definitions that are going to seem completely reasonable, but are actually extraordinarily important to kind of give a bunch of properties that are useful about constant function market makers. And then we'll see that how, you know, these things distinguish themselves from the classical AMMs. And then afterwards, kind of I can talk a little bit more about how it's related to a bunch of weird things that, you know, economists all know very intuitively, but which are not obviously related until you kind of write out the right definitions and then work with them. So, you know, the classical idea of CFMMs is like, look, okay, we have this big platform. It has a bunch of coins in it, or I guess in this case, tokens, let's say, because we're talking about Ethereum, right? And so we need a way of trading assets, right? And in particular, we also might need a way of measuring the price of given assets. So this is normally easy, right? You go up to the street, you go up to someone on the street, you say, look, I have, you know, whatever, here's $1, you have €1, or I have, you know, whatever, I have $1.1, I have €1. Will you accept this trade? And congratulations, that's the price of your asset. Right. So generalizing this slightly, you get this notion of order books where it's like, look, I'm willing to pay, you know, 1.1, I actually don't know what the euro is at, but let's say $1.1, which is quite low, for, you know, €1. And then if someone else is saying, look, I'll take $1.09 for €1, right? Then of course that order gets executed, everyone's happy, and all of these things. So the problem, of course, is that, look, this is a linear space requirement in the number of outstanding orders. right? This is not a problem when your markets are super illiquid, but you want your markets to be liquid, right? And in particular, storage and computation is extraordinarily expensive. So anything from order matching all the way to just like storing the outstanding orders on the blockchain is extraordinarily expensive and will make trades even more expensive. Another thing that's weird about this, and this is very common in tokens that are starting out, is that the price actually updates pretty slowly, right? Because the price in kind of the classical order books only updates whenever a trade is actually made, right? And in some sense, right, if we have a small number of agents that are interacting, the price is always going to update pretty slowly until there's enough liquidity such that like the price actually tracks some true market price, so to speak. Whatever, there's a God-given price that exists, and the idea is the market somehow tracks it. And of course, there's the whole problem of exchanges also need to add subsidies to ensure there's enough liquidity for trading, which makes this slightly more difficult. So the idea, and this is very much borrowing the broad idea of automated market makers, which were known in the classical literature since 1969, or at least it was the earliest reference. There might be earlier ones, but is look, we're going to use just a very basic formula to determine how we should price our assets. In this case, what we're going to have is we're going to have a bunch of liquidity providers who are just agents. I mean, they can just be, we can call them the market makers or something. But what they're going to do is they're going to pool their assets, which we're going to call A and B just very generally, but you can think of any assets, whatever, into some reserves. They're just like boxes which are just given to someone, right? And the idea is, look, if we set the price too low for someone to trade, asset A for asset B, then of course people are going to be highly incentivized to purchase the reserves. And of course, if we set the price too high, then people are going to be incentivized to sell to the reserves, right? So in some sense, we have this balancing act, and now we have a feedback mechanism for kind of correctly setting the asset price. So as before, right, what we're going to do now is we're going to take the current reserves and, we're going to make some sort of formula based on them that says, look, if too much of asset A remains, then we're going to just simply decrease the price of asset A, and so on and so forth, and vice versa, right? If too little of asset A remains, then we're going to increase the price of asset A because clearly it's more valuable than we're making it out to be. And so here's a trivial example. The price of asset A is $1. Okay, so that's a fixed asset price, and that's just kind of what we call a flat line. And this is actually a pretty common automated, or CFMM in this case, called M stable. And another one actually is similar, almost as simple, but says the reported price is actually going to be the ratio of how much of asset A I have to the amount of asset B that I have currently in reserves. And so this curve is an extraordinarily famous one that has like billions of dollars of liquidity, and it's called Uniswap. And if you've ever touched anything about DeFi, this is going to be like the first thing that you ever hear about. So kind of a brief history of AMMs, and again, this is a brief history TM. This is not a real history because it turns out these things are kind of vaguely related. So Winkler, Savage, and Hansen, again, so 6971 were kind of the original references, and then Hansen like popularized the LMSR. Essentially are these notions of these logarithmic market scoring rules that can be used for prediction markets. And so in some sense, they align the incentives of people who have some sort of information or some distribution about what they predict a future event will be, right? And the AMM kind of will incentivize them to correctly report the distribution in order for them to get the maximal expected payoff. Then we have Chen and Pennock in 07 is like, look, actually all of these things, here's a beautiful axiomatic formulation of all of them. We can include not just the LMSR, but a bunch of other like way more complicated rules. Then Offman and Sandholm, who kind of did a bunch of the more closely related to CFMM's part of this, realize that actually, you can make liquidity sensitive AMMs, and the problem is that market makers have unbounded loss in some of these markets, and they showed that you can actually prevent that from happening by having this notion of liquidity sensitivity. And then they make something that's actually almost similar, I will say that, for to CFMMs, which is these constant utility automated market makers. And then after, so things kind of stop there. I mean, there's more developments, but nothing really that's like, as similar as really the 2011 paper, so it peaks then. And then Bieder and Koppelman and Liu in 2016, kind of in a Reddit post, say, look, it turns out we can think of this idea as AMMs as just much more general, and then realize this notion of a constant product market, which is the Uniswap thing we were talking about before, and say, look, actually, this can also be used as an exchange and a way of measuring prices, and et cetera. So a bunch of like very nice properties, which they intuitively realized, but not obviously like laid out. So to give a flavor of how kind of absurd all of this is, so constant function market makers, this is, sorry, I apologize, this is a bit of an old figure, but in September of 2020, we've reached about $23 billion of trading, I think daily trading volume, if I recall correctly. And some of that growth, or I guess a good amount of it, is driven by the fact that decentralized exchanges are very, very easy to use. And in some sense, by providing liquidity, you can essentially kind of automate your own trading activity by having a portfolio, by being a liquidity provider to such a AMM. So I guess quickly, we'll get to the more theory part of this. I might have to rush a little bit more through this because I see that we are slowly running out of time. But so we'll go through some quick definitions of properties of CFMMs. And again, some of these are very much crossing the T's, dotting the I's, but the point that you should get out of this is like, there actually turns out to be a very rigorous, like very specific theory about CFMMs that you can say about, like you can say a lot of things about them, and there's still a bunch of open questions. And this is just like a tiny, tiny, tiny part of the ecosystem that turns out to be extraordinarily important yet again. But the point is that, you know, people are kind of looking at these things more rigorously than one might expect from, you know, kind of a surface level view of DeFi. And there's a bunch of interesting kind of frameworks that combine all of these things together. So anyways, with that big disclaimer, so in particular, look, we've talked about all of these things as black boxes, right? Let's give kind of the definition. So any CFMM is defined by some trading function. We're going to call it phi in this case. This is, I think, pretty standard in the literature by now, which is weird to say that there is standardization in the literature. But and the idea is, look, we have a function that takes our reserves. So R in this case is going to be the quantity of reserve amounts in n different coins, some input amounts. So in this case, if a trader, you know, the trader will give some amount delta to, and delta is again a positive vector, to the CFMM contract, and then some output amount lambda, which is what the trader expects the CFMM contract to output to it. And in this case, the reason why they're called constant function market makers is the trade delta lambda is what we're going to call them, is accepted if and only if at the current reserves, the function stays constant, right? So kind of what we're saying is, look, we have a function that depends on delta and lambda. You better hope that the delta and lambda you propose makes sure that that function stays constant, right? And this is hence the name, you know, obviously constant function market makers. And of course, once, you know, okay, so let's say the CFMM accepts the trade delta lambda, then of course it's kind of obvious that it's going to take delta from the agent, pay lambda to the agent, and therefore it's going to update its reserves by just adding delta and subtracting lambda. So these are just some examples. So I mean, don't worry about the specific formulas, but the point is, like, look, essentially everything that we know that exists is for these decentralized exchanges is going to be a constant function market maker. And M stable, which is the thing that just simply reports, here is the price, it's one of this asset, is given by this kind of very simple function that just sums all of the reserves, the inputs and the outputs. Balancer, which is kind of this generalization of Uniswap, is essentially a geometric mean of the reserves plus some fee minus the outputs. And then curve is actually very complicated, but the point is, like, look, you can express it in this weird way, right? And it turns out you can, based on this like expression, which is, it looks complicated, it's not as complicated as you would think. You can derive a bunch of useful properties about it. But the point is that all of these things are represented by this function phi. And if phi satisfies a few properties, which all of these things will, right, then we can say a bunch of stuff about them that is like totally not obvious from just looking at these equations. So to do this, we're going to define this crazy thing called the reachable set. I mean, it's very intuitive, but it's kind of not obvious that this is the thing you should be looking at the first time around. So in particular, if you think about any feasible trade, there's only a small number of things that are actually feasible trades. And therefore, one might expect that only a small number of reserves, right, are actually feasible in some useful way. So in particular, the values that the reserves can take is a very small set relative to the set of all possible, you know, non-negative vectors. And so what we're going to do is we're going to introduce the reachable set, right? The reachable set is simply a set of all of the reserve values that can be reached via any one feasible trade. And what we're going to do, this is going to be a weird thing, and this is the key, is that we're going to add the set of trades that are strictly worse for the trader as well. So in particular, the trader put in a little bit too much or took out a little bit too little of what they were expecting, right? So this idea is, if you've studied optimization theory or convex analysis or anything, this is essentially like kind of like an epigraph, except that we have the epigraph is in two directions. So it's on the input and the output, which is a slightly weirder generalization. So let's take Uniswap as an example, which we talked about essentially as this product, this constant product market. So if we plot the feasible reserves, essentially what we're going to get is that we're going to get a hyperbola, right? This is a set of R1 times R2 is going to be equal to some constant. So in this case, the constant is 1, right? And so we get exactly, R2 equals 1 over R1 or whatever, right? And so, of course, traders are completely allowed to exchange coin in the reserves. And by definition, the whole point is that traders can only exchange coin if they stay on this curve, if the reserves stay on this curve after the trade has been completed. So what we've done, in some sense, is the reachable set just adds all points above and to the right. So in some sense, we filled in the graph, right? And so of course, the things that were feasible before are still perfectly feasible, right? But the important thing to note is that, no rational trader is ever going to pick a point inside of the set, right? So the set of points which are dominated, essentially is called a dominated interior, right? And no trader is ever going to pick a point in the dominated interior. So in some sense, one way of thinking about these constant function market makers or these invariants or these trading functions is essentially as the Pareto optimal frontier of reserves from the perspective of traders, right? But the kind of an immediate thing that should jump out at you is, look, this thing is convex, right? So it's going to have a bunch of weird, useful properties that immediately come from convex analysis without having to do pretty much any work whatsoever. So as before, look, the resulting set is convex. So here's a beautiful thing. It's going to be in polynomial time to optimize pretty much any linear function, right? So in particular, what that's going to mean is that people are incentivized to correctly perform arbitrage over the set, or they're incentivized to optimally trade over the set, and this is an easy thing for them to do, and so they will do it, right? So in some sense, CFMMs are efficient if they are convex. Another thing is that the reachable reserve set is actually unique, is essentially unique over the trading functions with respect to rational agents. So if you have two things that have the same reachable set, they're unique for all intents and purposes, unless you have someone who's irrational and is picking points inside of that set. Another beautiful thing that happens to work in practice, there's no justification for this, is that, look, almost all CFMMs have some sort of easy way of formulating the reachable set. And overall, it actually, this specific definition leads to very, very simple definitions and proofs for a bunch of things that we might care about CFMM. So we'll see what kind of those are rather quickly, but the point is, it'll lead us to this notion of path deficiency, which says that you can't kind of arbitrarily change, you can't screw with the CFMM too much, so to speak. And then it'll also lead us to a bunch of things like, what the marginal price. So assuming there's some infinitely liquid external market, right? So like general price that lives out there, right? An arbitrator will always be incentivized to make the price reported by the CFMM equal to the external market price. Similarly, it will also say things like the liquidity providers will never, at a given cost vector, liquidity providers will never lose, or the returns will never be non-negative for a fixed cost vector, right? So for a fixed external price, every trade can only help liquidity providers in terms of like total returns. Another thing that it will also give us is it'll give us a perfectly reasonable way of computing the marginal or the total portfolio value of a liquidity provider, just via very basic convex analysis. So here's a weird definition, and it's about to, sorry, I apologize, I'm throwing a lot of definitions in a very small amount of time, but again, what you should get out of this is that there are a lot of definitions that kind of work out very beautifully and will And you can go read more carefully about them in any one of the papers that are available out there. But so in particular, we'll say a CFMM is path deficient, right? If the reachable set, if you remember that hyperbola with all of the filled in points on the top right, right? So if a reserve is reachable from the current time, so if someone makes a trade for the future, right, then the set of reserves that are also reachable is no larger than the current set of reserves, right? So in particular, the set of reserves just kind of gets smaller. If you want to think about it, it gets pushed up and to the right. So in particular, all CFMMs in practice are actually path deficient. And kind of another thing that's very important is, as I was saying before, for any fixed price, right, then liquidity providers' profits will never decrease. So, and this is a one-liner based on our definition. It says, look, okay, we're taking the infimum over all possible reserve values, right? If that thing is non-zero, then certainly because the things that are reachable after T trades is only become smaller, then certainly that new set, or the infimum over the new set, needs to be at most as large, needs to be at least as large as the infimum over the larger set, right? Which itself is going to be smaller than or equal to, right, the current reserves, right? Because we've taken the infimum over all reserves, and here is a specific point, which at time T, right? So it gives us this kind of one-line proof that these liquidity provider profits never decrease below a fixed threshold, assuming the first thing is non-zero. And another thing to note is that actually here's another weird distinction between LMSR or classical AMMs and the CFMMs, is that path deficiency is a thing that essentially is unheard of in classical AMMs, because those things essentially have to be path independent for anything to make sense. Another thing that it shows is like, look, it turns out people are not incentivized to split up their trade. So arbitrageurs are incentivized to perform exactly one trade, which matches the price to some external market, just on the dot, right? There's no incentive. In fact, it's strictly worse for them to try to split up their trades in some weird way, such that they can maximize their profit. So it turns out that arbitrageurs will maximize their profit by essentially making exactly one trade, which makes the current price match the market price that exists out there. And I say out there very facetiously, because that's obviously not a thing that exists, but if it did, it would be great. And one can show essentially, kind of as we'd expect, that the optimality conditions will imply that the cost vector, which assigns a price, is going to be a supporting hyperplane of the reachable set at the optimal arbitrage trade. So in particular, it means that arbitrageurs are incentivized to make the reported price of the CFMM equal to the price out there, again, in a single step. So the idea is, the CFMM will report any price as just a supporting hyperplane of SR at the current reserves. So in Uniswap's case, this is, if the reserve 1 is at 2 and the reserve 2 is at 1/2, right, then the reported price should be essentially 4 in terms of R1, or 1/4 in terms of R2, right? So I'm going to skip a little bit over this because we're getting very close to the time limit. But the idea is we can now write down very simple expressions for what the total reserve value at a given price is going to be, and in particular, if CFMMs have a specific form, which they often do, actually, in fact, almost always do have this form, then you can write a one variable convex optimization problem, which can be solved numerically, millions of times per second on your machine, such that the portfolio value, that gives you the portfolio value at any specific cost vector. Another thing that it shows is that it implies that constant function market makers will always have, in some sense, what we call negative gamma, right? So gamma will always be strictly or less than or equal to 0 in particular. So the pricing function with respect to the asset, the underlying asset price, the portfolio value with respect to the asset price is always going to be a concave function, no matter what you do, right? You're always screwed. So this idea, this is sometimes called impermanent loss, is always going to be non-zero. Is always going to be at least 0, and it's often going to be much worse. So in a few useful cases, this lemma gives you a bunch of closed form solutions that were previously not known. So for Uniswap and Balancer, you get this very simple formula. And very generally, that a bunch of things are not going to have closed form solutions. Sorry, that's just how all of these things go. But the point is that now you have a one-dimensional convex problem that you can solve, super efficiently on your machine. And so you can do whatever if you want to Monte Carlo, 100 million simulations, it's going to be a joke, right? Versus trying to compute some sort of optimal over a much more complicated object. And so get to the conclusion, 3 minutes left. But the idea is, look, what we should be doing is we have to set up your definitions right. And once you do, you get this kind of very simple thing that CFMMs can be studied in terms of these objects, this object called the Reachable Set, and some other object I haven't introduced here, but we introduced later, called a trading set. Not their trading functions. It turns out the trading functions can be very, very complicated, but in the end, it doesn't matter because they're just convex, right? So you can solve a bunch of things, and you can solve for a bunch of properties that you might be interested in, but you simply can't do algebraically. So again, these things have very clean definitions of importance. And so my point isn't looking at these things theoretically. If you look at the white papers, you're going to be super confused. But if you look at kind of a slightly higher order perspective, what you're going to find is all of these super useful theoretical properties are just stated extraordinarily cleanly, and could be useful to solve a bunch of problems that we might be interested in. Another thing that it implies in this case is because all these sets are convex, arbitrageurs can easily solve the arbitrage problem. And so therefore we expect the reported prices to match the external market price extraordinarily consistently. And in particular, what we'll find is that, look, every CFMM so far that is out there satisfies the convexity property and satisfies all of these very useful properties and can be analyzed under this framework. And one can imagine a bunch of other things too, right? That could, right now, what we've been doing is taking this big space of things and then formalizing it under one framework. But now you can imagine taking the framework and making a new thing based only on this framework that is, of more interest potentially than one would have if simply when we're looking at, these super complicated equations that people have come up with in order to price assets correctly. Cool. And then, yeah, so thank you. I guess I'll take questions in the 1 minute remaining or something like that. I don't know how that works, but.
Thanks. I think we have a little bit of flexibility. So I'd suggest that Tarun, Alex, Guillermo, you can, if people can raise their hands, you can interact with them directly. And
cool. Here, let me stop sharing my screen so we can all see.
Yeah, and Alex and I tried to answer a bunch of questions.
Done a great job, yeah.
Oh my gee, yeah, I see.
And you don't make any
man.
typing
Okay, that's
errors.
a lot of
That's amazing.
It's either that or autocorrect is really, really good for Tarun.
I didn't know if there's.
Sure
I don't know if Zoom has autocorrect. Does it?
But your Mac might. Anyway, sorry. Okay, we can get people up here. I have no idea how to do this, so I'm super technologically not adept.
I don't think anyone's raising their hand. Right
if
now.
anyone would like to raise their hand and ask a direct question, please feel free.
I think everyone's gone off to.
I think you've done such a
drinking
good
or
job
something.
in answering questions comprehensively. Okay.
Good. Okay.
Thank you very, very much. This has been extremely informative. And yeah, I think you're probably going to get pestered with emails for people calling. We really appreciate it.
No, this is great. Thank you so much for organizing this.
Awesome. Thanks. Oh, wait, we did just get a hand raise.
Oh, there we go. Look at that.
All right.
Freddie Farmer. Okay. Now I'm worried.
Great name.
Yeah. Great name for DeFi here.
Hey guys, can you hear me?
Yeah.
Yes.
Hey, yeah, no, it was a question. Anyone can answer it, but for those maybe in the audience who haven't done the on-chain, analysis of maybe the more professional LP providers in the AMMs you mentioned, using kind of some of the functionalities of the AMMs you described just recently, what kind of actions have they been taking to maximize their own profits?
Without pointing fingers, I think there's a lot of people who have large centralized exchange positions who are hedging them on chain and vice versa, because liquidity providers kind of are natural hedging instruments right now until they have more options, like having options and other things like that. But I think a lot of it ends up being centralized, decentralized trading, ARB, as well as just like there's just a lot of borrowing of stable coins, both for real usage as well as for yield farming, so to earn further market making incentives. But yeah, at least that's as far as I know. I think the interesting thing is that large crypto holders are using these systems as a ways to get dollar liquidity without having to go through BlockFi or someone like that. And I think in the long run, the centralized lenders are going to kind of be squeezed because they rely on, most of their profits come from what's known as the Etn Underlying Premium. So the approved ETNs, the exchange traded kind of like funds that are not publicly listed, but are, accredited investors are allowed to purchase, like GBTC, and things like that. There's currently a spread between the NAV of the like pension funds can buy Bitcoin fund and the actual spot Bitcoin price. And most of the lenders, centralized lenders, rely on that. So they basically take your Bitcoin, they put in that, they mint that premium. That's how they fund their operations. And then they give you dollars. But that spread has been decaying. And if that spread goes to zero, I think the centralized lenders end up just being front ends for the decentralized protocols. It saves them a lot of legal costs.
Yeah, I think I think they already use a lot of the decentralized protocols with the consumer funds. I'm not sure what counterparty risk
right. Let's just say
counterparty risk they're taking in CDFI, but I guess you could argue it alleviates. It has the potential to alleviate, individual congestion on the chain for smaller users trying to do transactions.
Yeah, for sure. And I think this is why I said the architectural interchain stuff is going to be important. When I say interchain, I don't just mean like other layer ones. I mean these kind of roll-ups too. Because there's kind of a sense in which people have different time capital preferences, and like it might be better to offload some of the demand to chains that are higher bandwidth, lower latency, or higher latency but higher bandwidth versus like lower latency, low bandwidth, right? This is what you see in normal finance. It's just not transparent to like the end users. At least here, it's like, having worked in HFT, it's like, how many people on this call like know what the Eurex like packet number sequencing is? Because that determines almost all the profit on Eurex. It's not like, oh, like there's actually fundamental arbitrage going on, right? So I think like at least here it's a lot cleaner than the way it is in HFT.
Cool, thank you.
Of course, you're gonna have to be able to program to use it though. So there's a higher barrier to entry, I think. But
cool, thank you very much.
Yeah, I think we got one more.
Yeah. Hi. Nice talk. Can you hear me?
Mm-hmm.
Yeah. So I have a question in the chat actually. So it's a practical question because essentially smart contracts actually built on chain, which has a speed limit. So you have only that many chains, that many blocks each, let's say, minute, which means that your order flow is actually it's like a discrete time thing, and it's not actually going to be really fast compared to some centralized exchange which has really good infrastructure. So so I just wonder how long does the order get executed on DeFi exchange, and is my understanding correct? And also, does it mean that maybe at some certain time there's going to be a really overflow of order at those discrete timestamp? Yeah. And also another thing is that in your model, you really take into account the gas fee, everything. You have to submit the order, which is really complicated. As I talk to the practitioners, they want to do arbitrage. You have to really measure the gas fee really well. And can you also comment on that?
So just at a very, very high level, you're right. The execution, so when you're trading on a centralized exchange, somebody has a database that they're going to update with saying, okay, you have this much, and they just do it instantly. The thing that you trade off here is that you have a whole bunch of nodes that need to sync about what the state of that database will be. Is just one simple way to think about it. That's not quite exactly right, but it's about what's happening. So the trade-off that you get is that you get basically your state being stored on a bunch of different machines and everybody agreeing on what's going on, without having to rely on this centralized party to say how much you have and enforcing that within their system. So that's the trade-off that you get. You presumably have some preference for that type of system. So that is the trade-off that you give up. Does that lead to congestion? In theory, yes, and in practice, absolutely. A lot of people will spam blocks and they get filled up, and that creates, different auctions for who gets included and so forth. And it can be quite chaotic at times, especially when you have large amounts of liquidations. Tarun talked about some of those when he talked about some of the challenges that DeFi faces. Some of those are scalability challenges, some of those are economic challenges, and mechanism design questions. But I'll let Guillermo answer specifically on the models and whether they incorporate gas costs and how, because that's an interesting topic in and of itself.
So yeah, well, with respect to the models, I'm going to be slightly facetious here, but it's going to be true. Congratulations, you got yourself an open research problem that would be like make you super famous in the Ethereum community if you even came up with a very reasonable model of gas prices. Sorry, that's just how it is. So no, the answer right now is like, look, the assumption here is you're taking trades which are just so much larger than, so these aren't for like, you have your $50 whatever ETH to USD trade or USDT trade or something like that, right? This is like, these are trades that would be very large and therefore make gas costs negligible. But the point is, there's a very complicated interaction that happens in the system, right? This is not just like, oh, you're making some trade, it's this complicated, it's going to be this cost, right? The problem is that the actual gas cost will, I think people have been asking about this somewhere along on the chat, but the gas cost is going to depend on a bunch of things, and in fact, it's going to depend on your actual trade itself. So figuring out even just like 0.0001% of the dynamics of how trades affect gas prices and vice versa, how gas prices will affect the trades and how that will affect, your knowledge about other people's things. All of these things are complicated enough that actually like any reasonable model, even if it gets just like the negative first approximation of the right thing, is going to be just like, like you will be like a very famous person in DeFi if you or just the Ethereum community, I guess more generally, if you're able to come up with a reasonable model for this. So to answer your question, no, there's not a single thing I know or no research I know about like gas prices being actively modeled as like a feedback mechanism. There are some cases in which I think gas prices is used or considered as a dampener on like kind of crazy transactions happening where, like flash crash type transactions or flash crash type market events, right? And so gas acts as like kind of like a natural dampener. But apart from that, it's totally open range. Like congratulations, you're in the wilderness with like nothing to help you for now. So sorry, I guess I'm the person to bring the bad news or the good news, depending on whether you are, weird like us and interested in mathematical questions.
One thing though to remember is that this is like sort of fundamentally different than normal trading. And I think people who have not actually tried to trade, like build a HFT system, might not realize that like there's a lot of what goes on in order to be able to market make is like, and a lot of this is not spoofing or fraudulent activity. It's just you naturally have to cancel a ton of orders and spam a ton of orders, is because an order book as a data structure, you have to make O of N updates to update N price levels, right? You actually have to like go spray a bunch of add orders, cancel a bunch of orders, even though you're theoretically trying to approximate this continuous price schedule by doing this kind of like discrete update, because there's a tick size and there's a quantity size and they're integers. But automated market makers change that by making it continuous, but then making the gas bidding discrete. And so there's this trade-off where you're going from arbitrary latencies but discrete price space to discrete transaction cost space but continuous order book, which I think is like something that is fundamentally different. And I have yet to see any economics papers that I've ever read that have studied this, because it's not something that exists in the normal world in a lot of ways. It's like a weird combination of iterated auctions with like continuously traded order books.
Thank you so much. Yeah, so just as a practitioner, do you think if the Ethereum's block size or block speed, if they actually increase with the new protocols, are they going to improve the infrastructure of DeFi? Do you think that's true?
Yeah, kind of in the same way that JavaScript, honestly, one of the most terrible programming languages ever designed in human history, yet the one that impacts most people. There became things that relied on it and had huge economic activity and that funded the actual improvement of the system. This is the same thing. DeFi has tons of economic activity. There's actual use cases. There's people who care about it, people using it. And they're willing to suffer through bad UX and high fees to use it because it meets a bunch of their needs. And that means that will drive innovation towards improving that. And so I think it looks very similar in that way to like how JavaScript just sucks, but we've just built around it. And it's kind of, I think it's kind of an interesting blend of how exchanges decentralized in traditional finance. Like, we kind of in DeFi, we've naturally invented Reg NMS, which is kind of insane. If you know anything about the history of market microstructure, Reg NMS was really kind of the turning point in 2006. And it's kind of insane that like the aggregators who aggregate over CFMMs have kind of ended up, reducing net gas costs by doing things like this.
So Christine actually had to step out since we were running over time. And so I'm going to pinch hit a little bit here. So first, I want to thank all of our speakers for giving this excellent presentation. I want to thank all the participants who stuck around 15 minutes over. I just want to point out that our next event as part of the CBER forum is on, I think, March 4th, which is the first Thursday of next month. It'll be Will Song at Cornell hosting Itai Goldstein from Wharton. So I hope to see all of you there. And thank you, everybody, again for being here. Have a great day.
Oh, thank you so much. Yeah.